Good afternoon. Today is Tuesday, January 11th, 2022. Happy New Year to everyone. Welcome to our Covenant Wealth Strategies Stone Barn Speaker Series, the first one of the new year. I am Ward Keever, the founder and president of Covenant Wealth Strategies, and I'm joined today by Michelle Fisher, who is our Director of Strategic Communications and HR, is a member of our leadership team at Covenant Wealth Strategies. We are excited to have Ryan Dietrich, who is Senior Vice President and Chief Market Strategist at LPL. Ryan is a returning guest speaker and is a fan favorite of regulars here for our Stone Bar Speaker Series presentations. We're looking forward to an entertaining and informative overview of the economy and the markets as we take a look back at 2021 and we look forward to 2022. A couple of fun facts about Ryan Dietrich. He is a Bengals fan, and apparently they made the playoffs this year. I don't know. I didn't. It's not my news feed, but apparently the Bengals made the playoffs this year. So we're going to have Ryan tell us a little bit about the curse of what was it?
Curse of Bo Jackson.
Bo Jackson. Yes. I knew it wasn't Bo Derek, but I couldn't come up with Bo Jackson. How's that?
Close.
Yeah, close, right? So just having some good fun with that. But Ryan coaches his two sons in basketball. And in fact, they're having a basketball instructional lesson right now as we speak. Ryan just ran down to check on them. And Ryan's daughter is a cheerleader in 8th grade. Ryan got a meat smoker last year for a gift. And so he is learning how to the finer points of perfecting the use of his meat smoker. We might hear a little bit about that as well. Ryan earned his Chartered Market Technician, or CMT designation, as well as a BS in Finance from Xavier University and an MBA from Miami University. We are delighted once again to have Ryan Dietrich with us. Ryan, I'll turn it over to you.
All right. Well, thank you, Ward, and thank you, Michelle. And thanks, everyone, for taking some time out of your busy schedules to be here. So the curse of Bo Jackson, just very quickly, the last time the Bengals won a playoff game was 1991. Bo Jackson single-handedly destroyed the Bengals, 1-on-22. He beat them all. So we've lost 7 playoff games since. Ironically, we're playing the Raiders in the playoffs. So I was telling Ward before we started, wouldn't it be something if we lift the curse of Bo Jackson by beating the Raiders, which is when the curse started 31 years ago? We'll see. I could talk all day on that, but I'm not going to. So again, guys, there's a lot to discuss. I know hopefully a few of you have seen me before. I like to have fun. I'm gonna go maybe 40, 45 minutes. We're gonna leave a little bit of time for Q&A. And we do have how you can send the questions in very, very soon. Maybe we can share that right now. Let's just share that now. So, as we go through this, any particular questions that come up, you can email Michelle at the email address there, and I'll definitely love to answer any and all questions. So, we called our Outlook 2022 Passing the Baton. And it's kind of a playful way of explaining what's going on. You think about it, guys, we've had a great run in the stock market. We're going to talk about that. We've got a really strong economy. We're going to talk about that. A lot of it's because of fiscal and monetary policy. That's the Fed, and those are the levers that the government pulls to get the economy going after the worst recession we've seen since the Great Depression. That makes sense. But do we really want the government and the Fed kind of moving the economy going forward now that the economy's kind of out of the depths of it? I don't know. I'd say no, right? We kind of want us, the consumers, small businesses, corporate America. We're going to pass the baton from fiscal and monetary policy, which still matter, but not as much. Pass it over to businesses and capital expenditures, investing in yourselves, just doing things to keep this economic cycle going, which we absolutely think is going to happen. We do not see a recession taking place this year. I was on with you guys a couple times last year, I believe, at least a year ago for sure, and I think in the middle of the year too, and we said, hey, this is still going to be a bull market. It's scary, but the economy is going to grow. Things did even better than we expected, as we're going to get into, but that's what passing the baton means. There I am there, January 11th. A funny stat, not even funny, a stat about January 11th. 6 years ago today was my very first day with LPL and LPL Research, January 11th. Kind of crazy how fast 6 years goes, but I've had a blast. You know, it's fun. My job's fun. I get to go out and do webinars like this, get to go on airplanes, get to travel the world. I work with a 30-person research team that manages about $70 billion worth of real money. I say I go on TV. What I say kind of impacts things, right? It's how we see the world in my research team, and how we see things playing out. You can have people on TV might say, this will happen, pontificating. There's no impact to it. What I'm going to talk about now, in the next hour or so, is how we manage a lot of the money and how we see the world playing out. So it's something I enjoy. I love it. Don't take it lightly. Like to have a little fun with it, but don't take lightly the impact of kind of the things that we do, how we can help people reach their long-term investment goals. And it's really special. So one more time, there is how you can email Michelle there with any questions as I'm going through this, and we'll leave hopefully 15 minutes or so at the end for Q&A. So there's a lot to be thankful for, guys. We're going to do a quick review of last year. Again, when I came on last year with you, we said, hey, the economy will not have a recession. There's going to be a lot of policy, fiscal policy, monetary policy, which should be a tailwind. We also said the economy should be strong, earnings should be strong. We said stocks would probably be flat to down. I'm sorry, bonds. I don't know what I just said. Bonds would be flat to down, and stocks should see potentially mid-teen, if things go right, year. Well, it was better than that. All right. Stocks had one of their best years they've had in a long time. You can see on the screen here, 70 all-time highs for the S&P 500, the second most all-time highs in history. Only 95 had more. S&P gained like 27% for the year. All you got to know there, that's a really good year. Bonds actually were down a little bit. Pretty rare for bonds to be down, but all in all, it was a good year, kind of the way we saw the world at LPL Research. And I'm going to talk more about how we see 2022 playing out here. Just a spoiler alert, we do see the economy continuing to grow. We do see this bull market continuing. It's not going to be like it was last year, guys. As you can see here on the screen, something else to be thankful for about last year. The biggest correction we saw all year, those are those dots at the bottom, 5%, 5.2%. 5.2% correction from, I think it was September 4th to October 2nd, or vice versa, but it was from early September to early October. That's it. All right. You gained 27%, and all you had was a 5% correction. That's pretty spoiled. Our view this year, after the run we've had, I'm not trying to scare anybody. We're just trying to lay it out there. We think we could have a 10% correction this year, maybe even a little bit more. I know that sounds like, oh my goodness, that's going to be a lot. And it will be. It'll be very uncomfortable should it happen. But the average year, you can see there that orange line there, the average year sees a 14% pullback. So, as we kind of get ready and you work with Ward and the team, just be aware that this year is going to be a little more rocky, right? It's a midterm year, and I'll talk more about midterm years very soon. Midterm years tend to be more volatile. The Fed's going to start hiking rates. I mean, we're going to know all this stuff. The Fed's going to start hiking rates. You get more volatility when the Fed starts hiking rates. But the key concept, the consumer is in healthy shape, the corporate America is in good shape. That's going to help drive corporate earnings to justify the stock, this bull market we're in. And stocks, we think, when all said and done this year, when I come back to you guys in about a year or so, we can maybe hit potentially double-digit returns, maybe a little bit higher if things are strong. But it's going to be a choppy, frustrating, potentially period, unlike last year where it was, all 12 months, every single month at an all-time high last year. That's only happened one other time in history. So last year we were pretty spoiled. That's a lot to be thankful for as investors. So Henry Ford said this: when everything seems to be going against you, remember that airplanes take off against the wind, not with it. The truth is this economic cycle still has a lot of time left, but it hasn't been easy. It hasn't been, like literally yesterday, probably 24 hours ago, I got a text from, I played high school basketball at Springfield Catholic Central. We won a state championship in 1996. I was a junior, came back another year in 97, and we actually made the state championship my senior year, but we didn't win it. But anyway, in 96, we won it. We had a really, really good team. We had a guy who's Mr. Basketball in Ohio. We actually played Kobe Bryant, that Kobe Bryant down in Myrtle Beach when he went to Lower Merion High School. So we had a really good team. I just got a text yesterday, like 4 o'clock, right, 24 hours ago, that one of our coaches died. 11 days ago, he was in San Antonio at a basketball tournament, and he got COVID and tragically went into cardiac arrest yesterday and passed away. So that was kind of like a shocking text to get that. We all are dealing with this. We've had so much loss, obviously, over the past couple of years. So I'm going to talk about the economy being good and stock market being good, and hopefully it continues. We think it will. We're not naive to the social impact that all of this have had on so many people. When a relatively healthy guy in his mid-50s He was on a plane 11 days ago in San Antonio at a basketball tournament, and then he gets sick and tragically passes away. It's just like, kind of eye-opening when that happens. I know it's happened to everyone on this call. We all know someone impacted by what's happening and still happening. But I'm the investments guy, I'm the economy guy, and I do have to try to separate things. I mean, the truth is we do think there's some good times coming, but also when bad things happen, and they always do, unfortunately, they're going to happen. Just remember, that's, as Henry Ford told us almost 100 years ago, that's how airplanes take off when wind is going against them. So let's just kind of get into things here. 2020 was pretty bad, but 2021 was something all by itself. I'm going to share some real headlines that I discovered, or saw, not discovered, I didn't discover them, that I saw over the course of the year. First things first, anybody seen The Shining? Remember the very last second or two of The Shining? The Overlook Hotel, New Year's Eve, 1921. Maybe we should have known 2021 was going to be a crazy year, given it was 100 years ago that The Shining and that famous end of the scene there with Jack took place. But remember the Super Bowl? People literally had underwear on their faces at the Super Bowl. I don't know, maybe I'm getting older or something, but not Saturday, it was The Weeknd. The guy's name was The Weeknd. I called him Saturday. That's funny. Anyway, The Weeknd was the singer at the Super Bowl. I don't know who it was. I didn't know a few of his songs. When I saw people on underwear on their heads at the Super Bowl last year, I was like, oh boy, this can't be a good year. Fortunately, it was a pretty good year. Artist sells invisible sculpture for 18 grand. Like, here's a sculpture. Anybody want to pay 18 grand for it? That really happened. This is a real world one. Circus clowns are the latest pandemic related shortage in Northern Ireland. You can't even get circus clowns. There's a shortage of everything. All right. Last year, and there still is. You couldn't even get a circus clown. I mean, that's a real world example of it. This one's crazy. Elon Musk and other leaders sell stock at historic levels as market source. The date is December 9th, which, by the way, is my wife's birthday. The very next day, check out this title. Company insiders are back in buying mode. Even Tesla's Elon Musk. I mean, you can't make that up. Here's a crazy one. IRS reminds thieves and drug dealers to report their illegal income. Isn't that nice? That's an NBA player apparently before he went to the game. I don't know what to say on that one. I am almost done, I swear. Here's my personal favorite. Lottery winner arrested for dumping 200 grand of manure on his ex-boss's lawn. The guy won 125 million bucks, and next thing you know, he put $250,000 worth of manure on his ex-boss's lawn. Look how happy he is. That's a great mugshot there. Anyway, so we did lose a lot of people. I mean, my goodness, 2021 took Betty White right at the end, and a lot of people were lost. And again, we're aware of just the social impact of everything that's taken place the last, we'll call it 2 years. I mean, but fortunately, the economy still looks pretty good, right? The stock market still looks pretty good. We're talking about investments, and we still see a really bright future in 2022 as we move forward. And the good news, hey, we made it. We are on the other side of this. I mean, we're not out of it, no doubt about it. There's Marty and Doc, though, from Back to the Future, obviously many years later. So George Burns said, I look to the future because that's where I'm going to spend the rest of my life. Big George Burns fan. That was the review of last year. Now we're going to get into kind of where LPL Research sees things heading from an economy point of view, a policy point of view, stocks and bonds, and then we'll do Q&A. Love that quote by George. So again, I started 11 years ago today. That picture was taken 11 years ago this week. I just like to use it because look at that young guy. That's before we all went through the pandemic, and we manage a lot of money, like billions of dollars. And when things aren't working, like March 2020, you get a few more gray hairs. It's just what it is. So I like to see that young looking guy there, but I am a little more seasoned now, I think, after all of the things I've seen the last 6 years. But when I did this, Ward and I were talking before we started. I was a senior market strategist when I was hired 6 years ago today. When I did this 1.5 years, 2 years ago with you guys, I was a senior market strategist. I was promoted to a chief market strategist. So in the midst of a pandemic, it's not lost on me how lucky I am, fortunate I am really, that I was promoted. LPL has actually grown. We've grown a lot, right? I mean, the pandemic is in a weird, almost twisted way, really helped our business as the stock market goes higher and different people realize they need different support from the broker dealers. So it's been a good opportunity for me, and I'm honored that I was promoted and continue to just love what I do every day. So guys, Robert Wadlow, he was the tallest human being ever, almost 8 foot tall. You see him there. The thing about him, he looks like a superhero, right? And by the way, I heard this morning driving into work, Marvel movies, take like 23% of all box office sales like last year. They used to be like 5%. Like, talk about superheroes. My goodness, that they just dominate the box office anymore. But there's a superhero there, 8 foot tall, superhuman. He died a tragic death when he was 23. Nicked his, he was bound to a wheelchair at the end of his life. Nicked his knee, became a terrible infection, and tragically died. So the idea, he had pituitary issues, obviously, grew too fast. Just concept of growing too fast, right? Doing too much too soon. Just kind of store that in the back of your head as we kind of go forward with this. Sometimes you need to plant roots. Those beautiful redwood trees that grow out in Washington State. If they have mommy daddy trees, they grow slower because those steal the sunlight and they grow slower, the baby trees. So they plant good roots. If there's no mommy daddy trees around, they grow super fast, but they're more likely to be hollow, more likely to have bug infections, and more likely just to not live as long because they plant big roots. So just kind of have those concepts in your head. So we'll talk about the 7-year itch, which interestingly, as most of you probably know, 7 years into a relationship, a car, a job, that's when maybe sometimes you get a little tired of something. You kind of want to change for whatever reason. It's how our brains are wired. We can't really help how our brains are wired. And there's scientific proof behind this, which is interesting because I'm starting my 7th year now with LPL. I don't have a 7-year itch yet, but you never know. But I'm having fun when I do. But there is the stock market is very human. All right. I'm going to talk about the idea of a secular bull market and a secular bear market. The shaded areas, guys, are secular bull markets. What's that? That's when stocks go up for a long time, like decades. Not every year, right? But usually go up. So look at the first one on the left, 1950 to 1968, 18-year secular bull market. You know what happened 7 years in? The 7-year itch took place. 1957, bear market and a recession. Then stocks continue to go higher for another 10, 11 years after that. Then the 1970s came around, horrible time, low productivity, high inflation, terrible time for investors. Now, a few of you probably remember those times. Then funny thing happened, 1980, stock market broke out to a new all-time high. And that born the 1980s and 90s bull market for 2 decades. Add 7 to 1980 and you get 87. The curse of the 7-year itch struck again. 34% correction, fastest bear market ever, fastest 30% correction ever until March of 2020. And then you had another 12, 13 years of a bull market. Pretty amazing. And the peak of 2000, right? And the peak of 2000, massive valuations, tech bubble, accounting scandals, just different reasons, or just stocks went straight up for 20 years. Stocks peaked in 2000, as a lot of you clearly remember. Then you had the financial crisis after that. You had the tech bubble after that. Then the financial crisis a few years later. For 13 years, you had a secular bear market. 2000, 2007, 2013, stocks went literally nowhere. The 2000s were worse for stocks in the 30s and the 70s. Think about that. Now, the worst decade ever to invest was the 2000s. You know what we did then? We planted a lot of roots. That secular bear market that we all went through, the 2000s, opened the door for what we're experiencing right now, which is an amazing secular bull market. 2013, I think it was April or March, one or the other, the S&P broke out to new all-time highs, ending that 13-year secular bear market, opening the door for a new secular bull market. Add 7 to 2013, and what do you get? 2020. LPL Research had no idea we were going to have what we had in 2020, but we did talk outwardly about the idea of a 7-year itch. Well, it took place, 34% correction ever in 6 weeks. My wife gets my dog. My dog is apparently trying to say hi there. Sorry. He hates secular bear markets. He just gets all fired up about them. But anyway, the 34% correction ever. It took only 5 months for stocks to make up the 34% loss that they had in 2020. It took 2.5 years to make up the 34% loss from 87, but a new secular bull market was born. LPL Research did not predict it necessarily. Clearly the pandemic happened, but that's how we responded. Lou Holtz, famous coach, says life is 90% how you respond to something, 10% what happens. How our team responded, I'm really proud of it. We actually upgraded our view on equities the last week of March 2020. I promise you, no other broker dealer did that. I came on to you guys and talked about this before, saying we've been overweight equities. We even weight coming into the year of March 2020, upgraded our view on equities on March 26th of 2020, been overweight equities ever since and remain there. We continue to think stocks will continue to do better than bonds and better than inflation and better than cash. And we've been in there. We're one of the few places that did that. Our peers and competitors upgraded their views like in November after the election. in 2020. So just kind of think about that. But we're proud of how we did it. We're aware we're only as good as what you've done lately. But I think the way our team is constructed and built, we're going to continue to do some really, really fun things. But the key concept, right? History doesn't repeat itself, but it often rhymes. So said Mark Twain. We just had the 7-year itch. Look on your screen how long growth and bull markets continued after the 7-year itch before. Who's to say we couldn't have several more years of growth in the stocks and in the economy? I think that's pretty likely is our base case there. So just kind of have those big concepts. The other one to remember, though, the 2011 stocks are flat, 2015 stocks are flat, 2018 stocks were down. Not a lot, but they were down. That decade, stocks gained like 400%. All right, last decade. So it doesn't mean every year is going to be up. The last 3 years, guys, stocks went up 29%, 16%, 27% last year. That's a heck of a 3-year run. It's very rare for stocks to be up double digits 4 years in a row. And actually, we had a 5-year double-digit streak in the late 90s. We've had another time of 4 years in a row double digits. That's why we think we could happen. But honestly, hey, maybe this year we gain 7 or 8% when all is said and done. It's kind of choppy. That'd be okay. Kind of catch your breath for the secular bull that goes on. But the key concept, again, 2, 3, 4 years from now, it still looks like stocks are going to be the place to be for long-term investors. We're not in a secular bear market. Let's spend some time on the economy. So again, we thought the economy would grow significantly last year, and it did. We're looking at potentially 6% growth in the economy last year, which would be the best year since 1983. It wasn't perfect. The supply chain issues, and we'll get into all this stuff. There are some issues clearly with the economy, but still overall pretty strong. Jimmy Buffett said this: indecision may or may not be my problem. Well, here's this. We're not too indecisive on this one. We think the economy is going to grow between 4 and 4.5% here in the United States. Globally, we should see some solid growth as well. Again, the best year since 83. Hey, listen, who doesn't want 6% GDP growth and 1% inflation? We all do. It's not likely, okay? It's just not how it works. You have 6% growth, you're going to have more inflation. Here's the way I like to explain the inflation and supply chain issues. You take a $21 trillion economy and you stop it. Then you say, 2 months later, start up again. That's going to take a while, right? I'm getting up there in age. If I play football, or let's say flag football, for an hour, then I just sit around for an hour, and then I stood up and started playing right away. You know how that's going to go? And we'll probably pull something or get hurt. That's kind of what happened with the economy, And again, when I talked to you guys a year ago, I probably said inflation is going to come back down. We're not super worried about the inflation we're seeing. Well, that didn't take place. We had more inflation than we expected. Nearly everybody, from the Fed to Janet Yellen to presidents, everybody was talking about inflation coming back down. It did not happen, right? Inflation is still very high, higher than we wanted. A lot of that has to do with the third quarter. In the third quarter, the Delta variant came out. That shut down a lot of, it caused a number on productivity and manufacturing, but it shut down a lot of chips that are made in Asia and China, and it shut those factories down. That kind of had the first domino effect for all the supply chain issues, and made it a lot harder. My goodness, we got like a PS4 for my boys for Christmas. That's like the hardest thing in the world to find. It's like you can't find anything anymore. But anyway. It's just kind of unique with the Delta variant, but the good news is we're seeing some real good signs, okay, with the whole supply chain issue right now. Just last week, we had some data come out on the ISM manufacturing data. All you got to know, the prices paid were going lower, and the times for delivery were improving. So we've seen some supply chain bottleneck peaks starting to go down, starting to improve. Right, we're probably past the worst of it. The worst of it was obviously holiday season, everybody buying everything for a while. Now we're past that, so we're optimistic that these supply chain issues will work their way out of the system by the second half of the year. And when all is said and done, we think inflation could be less than 3% this time next year. Running at 6 or 7% right now. Tomorrow there's a CPI number going to come out. You're going to hear all about it. It's going to be one of the biggest numbers we've ever seen in the 30, 40 years. Again, that's more backward looking. The forward looking, we think inflation is going to come back down. We can dig a little bit more into that in Q&A if you guys want. I loved this cartoon. You might have saw it. It was popular. Little boy says Xbox. Santa says chip shortage. Little boy says vans. Santa says factory slowdown. Brats. Santa says raw materials. Lululemon, bottleneck at the port. Little boy says I should have been naughtier this year. Santa says we're out of coal. Check this out. Same week that goes out, that came out in the Wall Street Journal. America's power plants are low on coal. You can't make that up, but it's the truth. It was the shortage of everything. Just as we're trying to hire some people on our LPL research team, I can tell you, It's tough. I mean, the labor force, yeah, there's all these 4.5 million people quit their jobs last month. I don't know where they're all going because we've been looking, and it's tough pickings out there. It really is. I mean, it's a shortage of just about everything out there. But again, as we move forward, we're optimistic those things are going to kind of continue to open up, if you will, and again alleviate the inflation worries. I mean, let's be honest. Gold is like $1,800 an ounce. I don't need to look. Every time I look, it's around $1,800 an ounce. If the market, if the world was truly worried about massive runaway inflation, we think gold would be a lot higher. If the world was massively worried about inflation, we think that yields globally would be much higher than the 10-year yield around 180 right now. Okay, I mean there's something getting geeky. I mean, your break evens, yields versus inflation, things like that. But we're just not seeing the market showing massive worries about inflation. I know the media, and honestly, when you go to the store, you go get gas, I mean, hey, things cost more, right? But it's all about the future. The stock market's a forward-looking mechanism, discounts the now versus the future. And again, we're optimistic that those things are going to work their way out of the system. The economic expansion can last years. Here's something that I don't think most people realize. The average economic expansion lasts about 5 years. You can see it there in orange. Last couple cycles, you can see 8 years, 10 years, 6 years, 11 years. Some real solid economic cycles of growth. This one could last several more years. I know it sounds kind of weird, but after the worst recession since the Great Depression, we think it's possible. Now, it wasn't your average recession, right? I got a promotion in the middle of a pandemic, like I talked about. My father-in-law owns a restaurant in Cincinnati, Ohio. If you guys ever get a chance to go, check out Urban Grill on the east side of town. You know, their business was shut down, right? I mean, he was worried I was going to pay his mortgage two Christmases ago, and we hung out. My brother has more GI Joes than anyone you know. I'm not bragging. I'm just pointing it out. He sells toys at like the Holiday Inn on the weekends, right? That's his business. There's a lot of money, by the way, in a lot of these toys, Star Wars, all that stuff. So his business was shut down. All right, I got a promotion in the pandemic. So it wasn't your average recession. Good news, cool thing about my brother, he opened up a brick and mortar store back in November. So it's really cool. Everything had happened, but now he's opened up a brick and mortar store, what he wanted to do 2 years ago before the pandemic. So he's a good example of someone who kind of rolled with some punches, had some really tough times, but hopefully is really going to succeed going forward as this economic cycle grows. And he got a business now, got a brick and mortar store. He's hiring people. He's helping the community. Lots of people, believe me, millions of people are doing similar things. 4.5 million people quit their jobs last month. I think it's because people are going out there. They realize, you know what? Do I really want to work for a big company? Maybe not. I want to go do something on myself. I want to take a chance. Want to go to the bank, get a loan, create something, do something, make something better for myself, for my family, and for my community. I think that's what so many people are doing. Of course, a lot of these businesses probably won't work. That's just how it is. That's the chance you take when you quit a job to go form something on your own. But it's really cool. I think the way America just looks at things, and that's the ingenuity of our country, right? I mean, that's how things work. My goodness gracious, I forget his name all of a sudden. Steve Jobs. I can't believe I forgot his name. I talk a lot. Sometimes I forget. Steve Jobs said, most overnight success stories took about 2 decades to happen. I mean, I think we got a lot of people that are doing some really cool things right now as they're quitting their jobs, creating, doing things. We're going to hear a lot about, the next Steve Jobs and the next everybody, Elon Musk, whoever is going to do something right now. Probably one of those people that quit their jobs last month. So that's really cool that those things are taking place, I think. And it shows confidence, right? You wouldn't quit your job if you weren't confident about the economy. At least I don't think you would. So these are all kind of things that are cool. But I don't know. I just kind of went on a real big tangent there. But the key concept of what's on the screen here, we think there could be several more years left of economic growth. We can maybe hit 5 or 6 years, which would be an average cycle of growth. And if you've seen me before, I've said this joke, but it's always a funny one. There's a statistician put his head in a bucket of ice and his feet in the oven. I said, hey, how do you feel? He goes, well, on average, I feel pretty good. That's a good, funny little joke about averages there. Transitory. So the word transitory is one we heard all the time last year. It just means there's a definition. Let's read that. Of brief duration, temporary, tending to pass away, not persistent. We all said that was inflation, including LPL research for a good chunk of last year. And then, like I said, the game changer was kind of when Delta hit in the third quarter. Inflation was coming back down. Then Delta hit and shut down all the different factories and things in China and really impacted us and really spiked inflation globally, not just US, globally. So we realized maybe it's not quite so transitory. Literally in November, Jerome Powell, in charge of the Fed, so we're going to retire the word transitory. That's Raphael Bostic on the right there in charge of the Atlanta Fed. He has a swear jar in his office. It's not if you swear, it's if you use the word transitory. before you got to put money in. So the truth is, again, inflation is not just going to come back down to where it was a couple of years ago. It's slowly going to kind of taper off, if you will. But again, we kind of realize it's not so transitory, but still not a massive worry of ours. We're going to have 1970 style inflation. We just don't see it. Alan Greenspan said, I guess I should warn you. If I turn out to be particularly clear, you've probably misunderstood what I've said. He was in charge of the Fed. A lot of you might remember him from the 90s. It's kind of funny. He said a bunch of words made no sense, right? There was a time when the Fed would have a meeting and no one would know it. There was a time when the Fed would hike rates or cut rates. No one would know it. The good thing about this Fed right now is it's very transparent. Every 6 weeks you have a Fed meeting. That's just standard stuff. But what the Fed is doing now, it's very transparent. They say what they mean, right? I mean, Greenspan made a living, used a bunch of words, confusing everybody, then doing something different. I think he just liked cloak and dagger. He just kind of liked the idea behind it. We don't see that at all right now with the current Fed, and we kind of like that. What are they saying now? Hey, it is what it is, right? Rate hikes are coming. We're probably going to see a rate hike in March. We don't think March. Some people think March, in May, but there's going to be multiple rate hikes likely this year. The Fed is probably going to start. They are tapering. The Fed was buying $120 billion worth of bonds every month. They're tapering, meaning they're buying less and less and less. By March, they should stop buying. There's about $9 trillion. I'll show you right here. About $9 trillion in what the Fed owns on the Fed balance sheet there. There's Jerome Powell there. That they're going to start to kind of run that off, meaning start to lower that potentially later this year. These are all things that are taking the punch bowl away, which brings us to a really great quote about the Fed. And who knew there were so many good Fed quotes, by the way. The Fed's job is to take away the punch bowl just as the party is getting good. William McChesney Martin, former Fed chairman. He actually was in charge of the Fed, off the top of my head, like 20 years. He was in charge of the Fed longer than anybody in the 50s and 60s. But I think that's the truth, right? I mean, things have been good. Now the Fed's going to start to take away the punch bowl because inflation, right? I mean, you get back on this one now. Jerome Powell, for the longest time, said he's worried about the employment picture. Employment picture is looking pretty good. It looks like darn near full employment, to be honest. We're still 3 million jobs away from making up what we were pre-pandemic, so we're not there yet. We're pretty close to full employment, it looks like. So now the Fed is worried about inflation, and the Fed can tackle inflation a couple different ways, mainly by hiking rates, by lowering the balance sheet, and tapering. And those are the bullets in the Fed's chamber, I guess you could say, to kind of slow inflation down as well. And again, we do think they will do that. Now, you hear rate hikes, everybody kind of gets scared, right? You hear, oh my God, there's going to be a rate hike. Well, rates are 0%. Rates were 2.5% in 2019. Last I checked, 2019, stock market did pretty good, economy did pretty good. We survived with 2.5% Fed funds rate. Do we really need a 0% Fed fund rate right now with the economy kind of humming along? Probably not. Is the Fed behind the 8 ball? Maybe you could say they are. They're going to hike rates fairly aggressively here probably this year, it looks like. A lot of that's priced in. That's just called being hawkish. Geeky words we use. Hawkish means you want to increase rates. But what does it mean, right? And I'm showing on the screen here, the last 9 times the Fed hiked rates. You guys know what the S&P did a year before? Gained. So the key concept being stocks usually go up into the first rate hike. Well, safe to say we've been seeing stocks up. I know they bounced nice today, had a rough start to 2022. We'll talk about stocks very soon. But the truth is, again, stocks tend to do pretty well into that first rate hike. And it's looking like we're going to have 10 out of 10 here. Stocks will probably be up the year before the next rate hike, which again is probably going to be in May, in our opinion. But what happens next, right? What happens next after the first rate hike in a new cycle? Well, you can see here, 12 months later, higher, I think that's 9 times, 8, 1, 2, 3, 4, 5, 6, it looks like 8 times actually. The last 8 cycles, a year later, stocks were higher after the first rate hike in a new cycle. So we're going to have that first rate hike either in March or May in all likelihood. History would say stocks will probably be higher. Now, here's the catch. Check those numbers out on the right. 12 months later, 1%, 2%, 2%, 6%, 5%, 9%. Then you got 2 big outliers. All right. So maybe stocks are more in that high single-digit range. Not the end of the world. After a 27% rally on top of stocks have doubled, okay, since December 2018. The crash in the Christmas Eve 2018, the S&P's doubled. So more volatility, the cycle ages, maybe have a little bit of a mid-cycle slowdown potentially in the second half of this year. These things are all normal. This is how history repeats itself. But then you have a little slowdown and then kind of things accelerate, right? Third year of a presidential cycle tends to be pretty good. Why? Because the president wants to get reelected, so he's going to pull certain levers. Second year of a presidential cycle sometimes is a little troublesome. Midterm year is a better way to put it. Sometimes a little troublesome. That's when sometimes policy and things get a little ugly in Washington. Sound familiar? So anyway, just kind of things to be aware of, that hiking is not, rate hikes are not the end of a bull market. Let's just make that real simple and maybe just end it with that. History never repeats itself. Man always does. Voltaire. So Joe Manchin, I don't need to get into all the stuff. You guys follow it. Joe Manchin, he 2 weeks ago said he agreed to potentially agreed to $1.8 trillion Build Back Better. Apparently doesn't agree to it now, but we've seen this before. All right. Jim Jeffords from Georgia, which, by the way, congratulations to Georgia last night with a great win, pretty late. I was watching it. Really exciting game and just cool. I think if you're an Alabama fan, sorry, I just think it's cool. Somebody else finally gets the win. But anyway, so Jim Jeffords was from Georgia, Republican from Georgia. He did something very similar 20 years ago to the Republican Party. They all wanted this massive tax cut for President Bush, except one guy had a lot of sway and cut out some of the fat and different things in that plan, much like we're seeing with Joe Manchin right now with the Democrats. We fully expect the Build Back Better to pass probably sometime in the first half of this year. Here's the catch, though. Build Back Better has more taxes in it. All right. Jeff Bookbinder on our team, equity strategist, has said, you know what, the positive to this, and maybe why the market's rallied a lot, because they realize Build Back Better is going to get kind of punted. And a lot of the higher taxes we factored in, which would have cut S&P 500 earnings, aren't going to happen now. All right. I mean, we're likely not going to see higher taxes this year. We're probably going to be a 2023 story at this point. So that's just kind of interesting to see that. But again, we've seen this before. One person can kind of mess up a lot for a political party, even though it's his own party or her own party. So 20 years ago, it happened with Jim Jeffords and happened again with Joe Manchin. But still, there's still some fiscal policy in the pike. A lot of the things that the government did past last year is still flowing through. So still a tailwind, if you will. Now, here's a cool thing. I'm going to talk about debt because it's a real popular question. Monopoly was right. So Monopoly, really cool game. Big fan of it. Played a lot as a kid. I want to read you the directions to, or instructions, I guess would be a better way to put that. Instructions to Monopoly from the Great Depression. But I'm going to change one word. What if the United States runs out of money? Some players think the United States is bankrupt if it runs out of money. The United States never goes bankrupt. To continue playing, use slips of paper to keep track of each player's banking transactions until the United States has enough paper money to operate again. The United States may also issue new money on slips of ordinary paper. Playful way of kind of putting the fact that, yes, our country has over 30, I don't even know the number, 32, 33 trillion dollars worth of debt, close enough for government work. Adding more, right? It's amazing, but President Biden just joined a very select club. He upped the debt limit there, the debt ceiling. Every single president going back 100 years has upped the debt ceiling now. I think us and Finland are like the only two countries that do it this way, where Congress gets to vote on kind of how much people can spend. I'm not saying it's right. I'm not saying it's wrong. I'm just saying when you have the world's reserve currency, remember March 2020 when the market got killed, bonds got killed, gold got killed, it went up? The US dollar. We have the cleanest shirt in the dirty laundry. And that was a reminder to all of us when the US dollar was that flock to safety, that we have the world's reserve currency. And again, I'm not saying it's right, but we can run up a lot of debt, especially with yields still historically low. I mean, yields are historically low. Our country paid less on the debt that it owns last year than it did in 2015. How in the world is that possible? We've got trillions and trillions and trillions and trillions and trillions more debt now than we did 6 years ago. It's because yields are so much lower. So yes, if the 10-year yield went to 7% tomorrow, believe me, we could be in a lot of trouble. There could be some bad things happen if that took place. But we don't see that necessarily happening, fortunately. But again, we've had a lot of debt in our country throughout history. But here's the key concept that I think is so important. Our country's got a lot of debt. Consumers, FICO scores are up during the last recession. Consumers, if you look at balance sheets and equity to debt and credit card debt and all these different things, consumers is like in the best shape they've been in decades. Small businesses, corporate America, really, really solid balance sheets. Not a ton of debt out there, a lot of equity. So yeah, the US has a ton of debt, but what I think matters more for us on this call, for people who want to know what the economy's up to and what their investments are going to do, how corporate America and businesses and small and consumers are shaping up, That matters more for our investments, and that's kind of how we see things. Now, this isn't new, all right? Herbert Hoover said, "Blessed are the young, for they shall inherit the national debt." Said that like 100 years ago or 90 years ago. Is the U.S. going broke? That's from the early 70s. All right. The way legend has it, John Connally, he was the Treasury Secretary for Nixon, 1971, U.S. dollar and gold were pegged. We severed that. It really upset a lot of bankers around the world. In a room full of bankers, John Connally said this: "It's our currency, but it's your problem." And again, that has been the U.S. attitude toward debt ever since, right? Are we ever going to go broke? Can we just keep printing money? Isn't it going to be hyperinflationary? Listen, these are really tough questions. But I guess if there's any good news, it's we've had a lot of debt before, but again, it hasn't really mattered because we got the world's reserve currency, and what matters more is how small businesses and corporations and consumers are, and they're really healthy still. How are we doing time-wise? We're doing pretty good. I'll wrap this up in 10 minutes, and we'll do 10 minutes Q&A, and we should be good. Stocks, staying in the zone. It's not me who can't keep a secret. It's the people I tell who can't. Honest Abe, I don't think that's a real picture of Honest Abe, because I don't think they had glasses like that in the 1850s and 60s, but I think that's pretty cool. So here's secret number one. Hinted at this earlier. Midterm years can be rough. I shared this on Twitter last night. I am on Twitter. You follow me at Ryan Dietrich if you like some of the stuff I'm talking about. But this was really a popular one because midterm years, you can see there the intra-year pullback, a 17% correction in a midterm year on average. Check the returns out a year later, up, 32% on average. So guys, here's the thing. There probably will be a pretty scary pullback at some point this year because midterm years are the most volatile years of the 4-year cycle. It's just kind of the way things work. And then a year later, things do really well because, again, presidents want to get reelected. Here's a crazy thing. The Fed and the White House are supposed to be separate, right? That's how it's supposed to be. You look back at rate hikes, there's a lot of rate hikes in year 2 of a presidential cycle. You know what happens in year 3 and 4? There's a lot of rate cuts. I'm not saying it's all collusion. I'm just saying it's kind of interesting the way that works. And that kind of plays out. Maybe get some rate hikes this year, maybe no rate hikes next year. Who knows what's happening next year? I'm sorry, in 2023. I don't want to go that far. We are going to see some hikes this year, but maybe things change a little bit. But the truth is, again, you're going to get worried. You're going to call Ward. You're going to call up the team, Covenant, and be very concerned what's going on. Rightfully so. It's your money. You earned it. You worked hard for it for decades and generations. So you care about your money. You're fully aware of that. But I want to be very clear that there's going to be some scary points this year. And again, have that plan in place before the storm comes. The time to plan for the storm is not in the eye of the storm, it's before the storm comes. It's like right now, right? S&P is like near all-time highs. Things are good. We might have a 10% correction. Guys, we might have a 15% correction this year. Put a plan in place, what you're going to do should that potentially take place, because midterm years are pretty volatile. But a year later, you're going to be really happy if you kind of, in all likelihood, be happy if you kind of hung tough or even use it as an opportunity to add. They always say the stock market's the only place things go on sale. Everybody runs out of the store screaming. I love that quote. I think it's a lot of truth. Here's secret number 2. There's still a young bull market. I won't spend too much time on this because I did on the economic cycle. Bull markets usually last like 5 years. Yeah, this one's up a ton. This one's up well over 100% in a very short time frame. But just be aware that these bull markets, they tend to last a lot longer than most people think. So just blindly because we've had a big rally, does that mean the bull market has to end? No, not at all. Maybe we have some sideways consolidation, maybe a well-deserved 10 or 15% pullback. But big picture, this structural bull market's still alive and well and still pretty young. Secret 3, higher interest rates aren't bearish. You've heard all over TV where 10-year yield has moved higher this year. Technology stocks have been hit. Stock market's had kind of a rough start to the year. But is it because 10-year yield's gone higher? Is that really bad? History would say no. I mean, check out on the screen on the right there. The S&P 500 gains during previous times of an increasing 10-year yield. 45% gain, 26% gain, 33 for 38, 35, 45% gain. That is pretty powerful to me to say, you know what? Maybe we want the 10-year yield to be up around 250 this time next year, about 180 or so right now. A little bit higher trending yield. And what does that mean? It's the bond market's way of saying, hey, the economy could be on firm footing. You know, it's like taking the training wheels off, right? You start to cut rates and do things, take the training wheels off, let the economy grow on its own. Higher yields maybe are snipping out just that there could be better economic growth later this year or later this year. And that usually means stocks do pretty well. So secret number 3, higher trending yields isn't really a bad thing if you look back at history. So speaking of truth, lies, and truth, secrets, and lies, never forget what George told us. George Costanza said, it's not a lie if you believe it. So that's a funny one. 2020 is a midterm year. That's 100% factual. It's also mid-cycle year. What is mid-cycle? Well, you're not really near the beginning of the economic boom when it started, but you're not really at the end either. We found 30 years on the screen here, 30 years of mid-cycle. Okay, what you need to know, mid-cycle years tend to be higher 80% of the time. They're up 11.5% on average on the far left. These are the shaded areas. What I want you to focus on, the shaded areas of what I'm talking about. Those are mid-cycle years. You got 18, 66, and 77 on the left there. All right, those were down 5 to 15%. Relatively large declines, no massive declines though. So mid-cycle years tend to suggest stocks probably should do pretty good, up 11.5% on average. Remember that number, 11.5. Here it is again. After the S&P gains 20% like we did last year, the next year's been higher 9 times in a row. In fact, the average return a year later is 11.5%. Yeah, there's some red on there. So it's you can have a negative year after a big rally, especially after a 3-year rally where stocks darn near doubled, maybe, but it's not our base case. But again, low single double-digit gains, that makes no sense at all. Low double-digit gains this year is kind of something we think is possible, and this would do little to change our view there. Neil Ferguson said the dead outnumber the living 14 to 1. Ignore such accumulated experience at your peril. Also, Churchill said, the further in the past I look, the further into the future I can see. I love using the past, obviously, to tell a story, to show, hey, we've been here before. This is where things could be headed. And looking at the past tells us this. Let me get one drink of water here. We're in the middle of a 7-quarter win streak. That's a long win streak. As you can see on the screen here, one of the longest we've ever had for the S&P 500. Should we just sell? Should we just get worried? We're up a lot, probably should get out. No, no. 2 quarters later, S&P's never been lower after a 2-quarter win streak. You can see here, go back to the 50s, the last time we got to 7 in a row, and it stopped, and that was it. These things tend to continue to go on. It's never that simple. I'm fully aware, lots of other factors out there, lots of things to consider. We've considered a lot of things here so far in the last 40 minutes or so. The key concept being these cycles can continue. We just had a 10% gain in the fourth quarter, one of the largest gains ever for stocks in the fourth quarter last year. You know what happened the last 12 times? See where this is going. The last 12 times, this is back 25 years, that we gained 10% in a quarter. 2 quarters later, the S&P was higher 12 times. Just another way of showing this rare strength we've seen is not the hallmark of the end of a bull market or the end of a bull market, middle of a bull market. Sometimes it's the middle, it's the beginning, honestly, of a new bull market. So this is some incredible strength. And again, if we get to sell off, we get some weakness, probably want to use it as an opportunity. Earnings should be strong again. This is we won't spend too much time here. We're seeing explosive earnings in 2021. Next year, we could see potentially double-digit earnings growth in the U.S. on the heels of 50% growth. Check on the right there, the 8.7, let's just call it 9%. That's U.S. growth, earnings growth. The U.S. is going to lead the rest of the world in all likelihood in earnings growth. We expect that to happen. How we see the world at LPL Research, we still like stocks over bonds. We do like cyclical value, industrials, financials, materials, energy. Some of those groups are the areas we think will still do well as the economy grows. Yields go a little bit higher. Yields help financials specifically and value, cyclical value. Technology, popular question, given tech got hit pretty hard to start this year. We're more even weight technology. There's 11 S&P 500 sectors. I'd say we put technology around 5 or 6, kind of in the middle, kind of behind those cyclical value areas. It doesn't mean we don't like it. And in fact, some of the massive losses we've seen, I saw a stat, 40% of the NASDAQ is cut in half. That's crazy, right? So there's potentially some good values out there. I know tech had a good bounce today, so maybe there could be opportunity there. But again, cyclical value is still kind of our favorite area as it pertains to investments. We'll talk about bonds and do some Q&A and call it a day. How much higher can Treasury yields go? So Treasury yields, we came into this year saying a 10-year between 1.75 and 2%. Then we had like one of the biggest jumps to start a year ever. 10-year went almost to 180 to start the year really fast. But we think now it's pretty stretched. Do you think last year bonds actually? Well, here we go. Bonds have been bad, but it can always be worse. So bonds had a terrible year last year. They're actually down. Now we're down a ton. So terrible is a strong way to put it, but bonds were down. But just remember this, it can always be worse. So here you go. This is the Barclays Ag, your average bond fund. Bonds were down only for the fourth time in history last year. And the key concept, I know some of the questions came in about bonds. Will bonds be down again? Probably not, right? Bonds didn't have a good year last year. It is what it is. You see it there. Bonds will probably be up or down, up this year. So a year ago, I said bonds will be flat to down. This year, we're saying bonds will be flat to higher. We think bonds may be gaining between 3 and 5% this year. Not spectacular, but hey, better than what we had, right? And what are we doing at LPL Research? Well, I'm getting geeky on you here, but we're shortening up our duration. If yields continue to go higher, let's say the 10-year yield goes to 2%, which is the upper end of our range. Long-term treasuries will be impacted a little bit more. We're saying buy a little shorter term duration. We do like bank loans. We do like mortgage-backed securities. Just solid investment grade bonds are fine. It might not. You don't expect them to beat stocks. That's kind of where we are. We don't expect it to beat stocks. What we've done in our portfolios, we run for our advisors and our clients. We use geeky words like tilt. We've tilted more towards stocks over bonds, and that's worked out well. I think that'll still be the play. But bonds should do a little bit better this year than they did last year, and stocks probably don't do as well. When stocks gain 25% like they just did last year, the next year has never been up more than that. All right. So again, hey, maybe stocks gain 11%, bonds gain 4 or 5%. It's pretty decent year, all things considered, after the rally we've had. But so rare bad year for bonds. Don't expect that to happen again, but they still could underperform stocks. Sir Isaac Newton, I can explain the motion of heavenly bodies, but not the madness of people. That is a real picture from a divorce hearing in Las Vegas in 1999, as they divvy up in court with a judge their Beanie Babies. That is the madness of people. So you never know how crazy people get and markets get. I just said, okay, well, we like stocks over bonds and we shorten up our duration. Listen, bonds help you sleep at night. You never really know how crazy things are going to get. And here's one of the last charts I'm going to share. This is intra-month pullbacks on the S&P 500 and on the Barclays Ag. Well, let's just call it stocks. Stocks are the orange one. We've had like 30% intra-month pullbacks in stocks before. Let's hope we don't see that anytime soon. We don't think we will. But bonds pull back. The most they pull back is like 6%. Last week, the Barclays Ag had a 1.5% drop for the week. They lost 1.5% all year last year. That's a really extreme drop. Last year, bonds had a horrible first quarter. Treasuries had like their worst quarter ever the first quarter. Bonds had a really rough quarter as yields again went higher. But you know what happened in the last 3 quarters? Bonds did pretty good. They what they're supposed to do, right? They give you a little protection, little safety during volatility, and little appreciation as well, and nice dividends paid out. So bonds kind of did what they were supposed to when they had a rough first quarter after that. So again, bonds help you sleep at night. When March 2020, yeah, bonds were down a little bit, even because everything was selling off, like I said, except for the U.S. dollar. Bonds still did well relative to stocks there. So in conclusion, guys, I'm honored you had me back. I mean, no recession. Earnings should still be strong. Consumer looks good. Corporate America looks good. All in all, we think this bull market continues. You're going to be more volatile, though. The Fed hikes rates, aging cycle, more volatile. Just get that plan in place beforehand, and don't be. It's always scary. I mean, I get it. I do this for a living. You have a big pullback. I mean, we had a 5% correction last year. We haven't had a 10% correction in a long time. Odds are we're going to have one this year. So just start to mentally prepare for when that happens. And if you don't think you can handle a 10% correction, work with Ward, work with the team, and try to get your portfolios where you should. Maybe a little more bond, a little more cash is just a simple way to do it. But if you can withstand it, maybe use an opportunity for continued higher prices. I'll end it with this, guys. Enjoy the moment. There's my dad there, my 2 kids. I'm a Xavier guy, Cincinnati, Ohio. We are ranked 17 in the country. One of the best rankings Xavier's had in a long, long time. We've had a good basketball team on and off for 25 years. That's a picture of my dad, though. Like I said, he passed away 4 years ago on Thursday, the 13th. So this 13th will be 4 years ago. That was when we beat Villanova. They were #1 in the country. I guess it would have been 2017. I think it was 2017, either 2016 or 17. Anyway, we went to that game. I'm glad he did. He darn near had a heart attack walking up to the top of those steps. That was like really, you can't tell, but that's a pretty big stadium. So he almost killed himself walking up the steps. Sure, he's glad he did it, though, and made it. We had a fun time. So just enjoy the moment. We don't know what's going to happen. I mentioned my high school coach. Man, he passed away just like that. I mean, I'm not trying to get Debbie Downer here. Let's just enjoy the moment and really embrace things. You just never know what's going to happen. But we do think this economy is going to keep going up. I'll come back in a year, maybe 6 months for the mid-year outlook and do a little update. But we think, hey, stocks will still do pretty well. Economy's going to do pretty well. All right, guys. So there's the questions. Let me show a couple disclosures first, and I'll go back to that just to make everybody happy. So there's disclosures. And here is how you can email Michelle any questions if you have not already. So Ward and Michelle, I'm back. Yeah, we got a little bit of time. Let's do it. Q&A.
All righty, Ryan, thank you so very much. I always feel like I've been standing in front of a fire hydrant after you're done with your presentation, just with the volume of data and information and helpful information. So one of the questions that came in is LPL. Do you guys have a forecast, for example, on the S&P for the end of the year at this point?
Yeah, 5,100. Great question there. Probably should have pointed that out. 5,100 is what we have. So that's not all that far away where we are. We think earnings will probably, so earnings will probably grow between 8 and 9%. Jeff Bookbinder, our team, does think earnings, maybe if things are good, can grow maybe 12, 13%, which will help justify stocks. I hate having targets, though. Probably why I didn't talk about it. I think we're in a major structural bull market, but we do have a fair value target of 5,100. If the S&P 500 hit 5,100, say sometime later this year at some point, that doesn't mean we just change our tune and sell everything. It's okay, we're bearish now. I mean, we still like things. We hit our target a couple times last year. What we did, we just kind of upped our target. And the money that we run, kind of where things really matter, I guess you could say, we trimmed some models, yes, after the big rally, but we stayed with the overweights of stocks. But 5,100 is kind of where we see things. I talked a couple times about 11.5% gain. That's actually a little bit more than 5,100, but I think that's kind of where we could be. We have to make this target like in October when we write the outlook, and then you have a huge rally in December, kind of throws things off a little bit. But all in all, 5,100, Ward, is where we see it with about 10% earnings growth.
Great. And you had mentioned also that the fourth quarter of 2021, the markets were up about 10%, one of their best quarters ever. Could you speak to what happened in the third quarter?
Yeah, third quarter stocks did well too. I mean, I forget exactly what it was, but I know stocks hung in there. Stocks actually were down in September. They were down in January and September last year is all it was. Everyone got all worried, about August and then a summer sell-off, and that really wasn't the case. I mean, this was one of the rare years where stocks were just really strong, for the most part, the whole year. I mean, it's not like all 12 months were higher. Yeah, we had the January was down and September was down. But overall, it was still a positive quarter. All four quarters were higher on the year. Again, kind of a rare instance, if you will. Even though the third quarter is when Delta happened and a lot of the slowdowns globally happened, even GDP wasn't all that great. Productivity was not so great in the third quarter from the economic point of view. All the stock market held in there pretty well. Again, likely smelling better growth in the future.
So certainly flatter than the fourth quarter.
Oh yeah,
I think
no doubt.
One of the things that you mentioned is mid-years can be tough. Could see a 10 to 15% market correction. And I would ask maybe in the same way that September was a negative month, and I recall the third quarter being kind of flattish, if you will. That kind of set up the fourth quarter. So would it be fair to say that you guys are in the camp of, quote, buy the dip, meaning, for example, last week, yesterday, markets pulled back. And of course, I think the NASDAQ just yesterday, it's a short period of time, right. The NASDAQ was down by 3%, yesterday morning. And then there was enough, quote, buy the dip stuff going on that the NASDAQ wound up positive for the day yesterday and then rallied higher today. So to the extent that we see a 10 or 15% pullback, to the extent that we have a negative month or a flat quarter, would you guys be in the, quote, buy the dip camp in terms of seeing that as a good time to deploy cash?
We absolutely would. Speaking of the NASDAQ, so the NASDAQ was down nearly 10% intraday from its peak. Okay. I mean, that's almost a correction, right? I mean, and then we had a huge rally. The NASDAQ 100, so the largest 100 stocks, it was down over 3% yesterday morning and finished higher yesterday. You have to go back to March 23rd, 2020. That date might ring a bell. It was the day the market bottomed. That was the last time we saw that type of a reversal. So all this talk about higher yields and how it can potentially hurt tech, I get it all, we get it all, but eventually there's a value in there. And after that 10% correction, a lot of buy the dips, other people stepped in, and we would totally agree with that. So that's in our team. We have multiple team meetings every single week. We outwardly talk and map out and do coordinates on what could happen, what will we do if this were to happen, map these things out. So we're not, kind of deer in the headlights when it happens. And we are actively talking about if we were to get a 10% correction in the S&P 500, we actively will use that as an opportunity to add to various models and places that we think need to add a little equity risk. And that's what we will be doing with the money we run. Absolutely.
So Ryan, you're a CMT. And you might be aware of the fact, my understanding is that the NASDAQ yesterday at its bottom touched the, was it the 200-day moving
200-day.
average?
Yeah.
Can you speak
Look
to
at
that
you,
for a
Ward.
moment?
Good job. Yeah. Yeah.
Can you just speak to that? What's the significance of that?
Yeah, so 200-day moving average is like it sounds. You go back to previous 200-day closes and you average it out. And what happened, those was a long-term trend line. And again, why does it work? I think it works because a lot of people watch it. I know that sounds a little odd, but that's the truth. Yesterday, the NASDAQ did have that big reversal. It touched its 200-day moving average for the first time in a long time. You look at these long-term, 200-day moving average is about a 10-month moving average also. And you look at these long-term trends, you see buyers step in at these 200-day and 10-month moving averages, and it's happened time and time again. And it doesn't happen in just the NASDAQ. It happens in commodities. It happens in the fixed income markets. It happens in a lot of different places, but it's quite interesting. We had a major reversal yesterday at a major area of technical support, and boom, you had the rally. And again, it looks like tech, even like we think tech will probably, like I said, if the S&P is up 10% this year, we think tech might be up 11 or 12. We're not saying tech's going to be wide. We think financials and some of the areas do a lot better. But hey, if you get another couple good size pullbacks in tech, it can be a nice place for some people to do some addition and some adding, no doubt.
I admit to enjoying charts and graphs and just being very visually oriented. And I've explained it to clients that using technical analysis, like for example, your CMT, Chartered Market Technician, which by the way, here in our office, our very own Randy Eveland is working on getting his CMT. We also, of course, have Peter Baywa here in the office, who's a CFA, Chartered Financial Analyst. That's a pretty big deal. But I liken technical analysis to the idea or the illustration of basically having an onboard navigation system with a picture that basically says, here's where I'm trying to get, or here's where I'm trying to go, and it gives you navigation in terms of how to get there. And if you find that you're up in a situation where there's an unexpected detour, it recalculates and helps you versus just being lost in an unfamiliar area. So feel free to use that illustration if you like it.
No, that's good. Yeah, I like that.
Yep. Another quick question that came in here was if you can comment on some of the Chinese geopolitical stuff that's going on. I mean, we're watching this, and of course, Hong Kong and Taiwan and semiconductor chips and all that kind of good stuff. But can you comment a little bit on your perspective on what's going on in China and how that might impact U.S. and global markets?
Absolutely. I should have probably pointed this out, but sometimes get into it. One of the best calls I think we had as a research department last year, we came into this year liking emerging markets, overweight. We downgraded to neutral in June of last year, and by August, we downgraded to underweight emerging markets. We just saw some major structural problems, all the regulation going on with China, weak technicals. You mentioned technicals. We saw some different technical trends taking place, so we said, oh, something's up here. We don't know what. We want to get out of it. And then China goes after everybody, all these different things. Emerging markets were negative last year, and a lot of that was because they were so weak the last second half of the year. We had a pretty good call there. Even in our mid-year outlook when I was with you guys talking, we said we don't like emerging markets second half of this year. There's a banana peel there. And fortunately, that played out. So we still like the U.S. the most, developed international, Europe second, and then emerging markets third as we head in. But we think there's some big issues still with China potentially hurting economic growth with some of the regulations that they're putting out there. And it is what it is. They want to do that. There's probably better places for investors to look, in our opinion.
Yep. We also eliminated emerging markets positions in our actively managed portfolios last year. So saw a lot of maybe some of the same technical things that you were looking at. So as far as bonds, you had mentioned in your closing comments, but a question that come in during the presentation that in terms of bond investors, if you're expecting interest rates to move higher, and of course there's the Fed, right, which is the short end of the curve, but then there's maybe like the 10-year, which you referenced is now up about 180. Typically, interest rates and bond prices move inverse to each other. So for clients that are invested in bonds, whether investment grade corporates or governments or even municipals, you had indicated that you think that the bond market total return will be 3 to 5%. How do you get a positive 3 to 5% return on bonds and fixed income if we're seeing rising interest rates and bond prices go opposite interest rates?
Yeah, no, good, great question there. There are different sectors. So I'm talking about the Barclays Ag, right? Kind of your average bond. There are other parts. You look at something like mortgage-backed securities or bank loans. They actually had really good years last year, and or at least bank loans did, specifically floating rates. And we still think those areas can do well. The other thing, again, I mean, the 10-year yield started at 150, 151. Okay, and our range for the 10-year yield is between 175 and 2. You can still, if you have a gentle 25 basis point move in bonds, like kind of ballpark where we are right now, it happened already. If we're still in that area next year, by this time next year, you had these losses early, but you can still get some definite upside to bonds there. And honestly, even with something like treasuries, if the 10-year yield were to go sideways with some of the yields there, we still think there's a lot of demand. I mean, Ward, you look at it, our 10 years at 180, all right? Japan is negative. Germany is negative. The Swiss just went positive for the first time. There's like $13 trillion in negative debt. There still is, around the globe, there still is a lot of demand for our bonds. And we think there can still be some tasty buying, if you will, with our bonds. Even though our yields feel low, there's still a lot of global demand out there. So all in all, there are different pockets. But our favorite area in the bond area, according to Lawrence Gillum, our fixed income expert or strategist on the team, we do like bank loans the most. We think there's a little bit more yield, a little lower quality, but they can be an area that someone can get a little bit can do a little bit better if yields do drift higher. But I think this year's looking a lot like last year, where yields had this big move early in the year, then they might go sideways for a big chunk of the year, and that's kind of exactly what played out. So if someone still has some bond exposure, hadn't done anything yet, I think just hold tight. We just had this big, huge move in the 10-year yield. I think bonds will probably do what they're supposed to do, the next 3 quarters or so.
Yeah, especially with the 10-year starting right now today at 180.
Yep.
At this point, you've had a 20 or 30 basis point move in the 10-year. It might feel a little too late, to try to posture defensively. So, but your idea that whether it's bank loans, or it didn't necessarily say high yield, but bank loans are lower quality, higher yielding, that would also be consistent with your perspective on a continued expansion in the economy, low default rates. And so basically you're saying give up a little bit of quality to get a higher yield and look for a higher total return there. Is that fair?
Exactly. That's you said it better than I did. Exactly.
All righty. Well, Ryan, we are over time, and I want to be considerate to those who are with us. So personally, I could do this for another hour or two. Love listening to you. I think there's a wealth of knowledge, and love the Q&A as well. So thank you so very, very much for spending your time with us. We just pray blessings over you and your wife and your kids and your family as we go forward. Pray that you guys will stay healthy and safe. And I think Michelle and I are planning on being down your neck of the woods later this month. So we'll see about looking you up and seeing if we can catch up in person together. So with that, we will conclude.
Oh, sorry, I would love that. I appreciate you guys having me back. Everyone on this call is in great hands. Ward and the team are amazing. Anything I can do to help, I'm just a phone call away, guys. I can't wait to see you in a couple of weeks. So thank you for having me.
Thank you, Ryan. With that, we will conclude our Stone Barn Speaker Series, January 11, 2022. Guest speaker, Ryan Dietrich, Senior Vice President and Chief Market Strategist at LPL. Thanks much.